So good day, ma'am. Today we will be discussing the business combinations. So business combination refers to the uniting of different business entities into one reporting entity. Business combination is when two or more businesses will combine their resources to form one entity. So entity is something that has real existence. And then control refers to the power to govern the financial and operating policies so that makakuha ta og benefits from its activities. And there are reasons for business combinations. Business combinations may be undertaken for the following reasons. First, it is cheaper than expansion from within a business entity. Next is for its synergy effect and backdoor public listing. So cheaper than expansion from within, acquiring another company may be considered as a shortcut in business expansion because of the market, human resources, facilities, sources of goods and materials, and its goodwill. In times of recession, business acquisition would be considerably cheaper because of the deflated market prices of shares and stocks, and in some cases because of insolvency instructions. So one of the reasons for business combinations is the cheaper than expansion from within. So ang pag-acquire sa other company, ma-consider na siya shortcut to expand your business. So the reason is because of market, human resources, facilities, sources of goods, and its goodwill. So another is the synergy effect. So a business combination is expected to bring about more stable economic entity. So examples of synergy effect is capabilities and capacities, market positions and market shares, reputations and resources, and etc. That is greater the sum of respective assets. Another is the backdoor listing. An unlisted corporation may acquire another corporation that is already listed in the stock exchange. This enables to avoid the different requirements for public listing. So, ang backdoor is discard or strategies sa mga private companies that wish to become publicly traded. So how business combination is achieved? Hostile takeover. When a company is interested in acquiring another, it makes preliminary overture to the officers of the latter, followed by a tender offer. A tender offer is one that states the amount and nature of considerations that is intending to give. The combination is effected upon acceptance by the other corporations and upon compliance with all the legal requirements. In this case, the business acquisitions is described as friendly. When negotiations with one's offeree's officer do not push through, the offeror corporation may decide to approach the stakeholders directly with a tender offer to their shareholdings. A hostile takeover results when the offeror corporation is able to acquire controlling interest in the invitee corporation by purchasing shares from the latter's stockholders of the market. And then evaluating business combinations. The criteria in evaluating business combinations proposal may be as follows. First is the line of business. The acquirer must be engaged in a line of business that. Next is the existing facilities. So, how would the acquirer benefit from the use of the acquirer's plant, property, and equipment? So, unsaan pag unsay mako nga benefit sa acquirees from the use of property and equipment. Next is the existing market outlets, customers or clients. So how would the business combination affect them and how they react on the combinations? And the last is earning per share. So the business combination should result in an improved EPS or enhance its stability. Then cash flows. The business combination should result in improved cash flows and consequently provide more investment opportunities. Next is internal rate of return. So the combination must realize an internal rate of return that must at least be equal to the minimum desired of the rate in return. Cost of capital. Cost of capital must be least maintained if not improved for the combined entity. And risk reduction. The combination should result in a lower degree of operating and financial risk for enterprise. So, incremental cash flows arising from business combination may provide additional to the combined company, and the corresponding income and cash flows not yet included in the combined statement funding incremental investment companies. Middle managers must be able to minimize culture shock in the organization. So kaning culture shock, it is a normal process of adapting to a new culture. So it is time when a person becomes aware of the differences and conflicts in values and customs between their home culture and the new culture that they are in. So acquisition cost. So ang acquisition cost is kanang giving fair value sa assets nga ihatag sa mga utang and kanang securities. So the amount should be arrived to fair value of net assets, future earnings, and incidental incidental future cost. The next reporter would be Jason Ladaran.
So good day everyone. I am going to tackle about the business combination by fusion. So in business combination by fusion, two or more existing corporations are combined. It may be in the form of a merger or a consolidation. So kaning business combination by fusion, duha or more nga existing corporations which is combined gitapo in form of kanang pwedeng merger or a consolidation. So when we say merger, it is two or more corporations that are combined with one of them as the surviving or absorbing corporation. So in other words, an existing corporation acquires the assets and assumes the liabilities of one or more corporations. Kining merger nag-consist of two or more nag-combined, which is one of them act as the surviving, no? Means sila'y mo kanang mo manage or mo acquire sa assets or sa liabilities sa mao nga corporation sa tanan na which sa combined na corporation. For example, the kanang R corporation and B corporation are parties to a business combination with R corporation. So acquiring the assets and assuming the liabilities of the latter, B corp is subsequently dissolved. The combination may be illustrated as follows. So as you can see in the illustration, the combining corporations are the R corporation and the B corporation, which is result to the combined corporation, which is the R corp na laman, no? So next is the consolidation. So consolidation is a new corporation formed for the purpose of the business combinations as absorbs two or more existing corporations. For example, R Corporation and B Corporation are combined to form RB Corporation. This may be illustrated as follows. So you can see sa illustration, the combining corporation is the R Corporation and the B Corporation, and the combined is ang RB Corporation, na it means nga if i-combine na ang duha, which is kanang sila gyapong duha or ang more katutanan na ang kanang involved sa corporation mo manage about the assets and liabilities, murag opposite ra sila sa merger, kaya ang merger is ang isa raman. So kani ang consolidation is ang duha or ang tanan. So in the foregoing example, RB Corp is or corporation is formed to effect the combination. It acquires the assets and assumes the liabilities of R Corp and B Corp, and the latter are subsequently dissolved. So next is the estimated EP and PE ratios after a planned business combination. So what is EP? So EP is earning per share and PE is price earning. So these are ratios that are used as measures of the profitability and marketability of a company's stock. It is therefore imperative that in the negotiations for a business combination, the different parties estimate the EP and PE ratios for the combined entity. So the formula are as follows. So these are the formula. In EP, so earnings per share or EP ratio is equals to net income over the number of shares outstanding. And sa PE or price earning ratio, so price earning ratio is equals to market price per share over the earnings per share. For example, the X Corporation and Y Corporation are parties to a merger with X Corporation, retaining its identity. So the following figures are given for the companies. So as you can see in the illustration, nadira ang net income per annum or the net income, the number of shares outstanding, the market price per share, earnings per share, and the price earnings ratio. So and the sa pika sides, the X Corporation and the Y Corporation, below are the amounts. So in net income per annum sa X Corporation we have 50,000 and Y Corporation is 40,000. And the number of shares outstanding is 5,000 and also in Y Corporation is 5,000. So market price per share we have 220 pesos and sa Y 180 pesos. Earnings per share we have 10 pesos and 8 pesos. And the price earning ratio we have 22x and the 22.5x, kay ang x naman ang mo dala kay merger man siya. So kani ang 50,000 divides katong una nato nga inikuha sa nato sa earnings per share, di ba, sa EP is divide ang net income over the number of shares outstanding. So 50,000 sa X Corporation, 50,000 divide 5,000 is 10. Mao nang earnings per share. Sa Picas is 40,000 divided by 5 equals 8. No, mao ni ang earnings per share. So karon inikuha nato sa price earning ratio, i-divide nato ang market price per share sa earnings per share, kaya nakakuha ang tag earnings per share. So market price per share which is 220 sa X Corporation, i-divide nato sa 10, mao na naatay 22 X Corporation na. And sa Y Corporation 180 sa market per share divide earning per share nga 8, we have 22.5. Let us see cases. So in case A, X Corporation issues shares of its capital stock in acquiring Y Corporation on a 1-for-1 basis. Annual earnings after the merger have been estimated to be equal to the total of the earnings of the constituent companies prior to the combination. The estimated market price per share is 216 na sila given na nga 216 aning sa market per share sa case A. Okay. Sa case B, we have here X Corporation issues shares of its capital stock in acquiring Y Corporation on a 1-for-1 basis. Annual earnings after the merger have been estimated at 120,000 pesos na. So ilahang earnings sa ilang merger. So estimated market price per share after the combination shall be 225. So sa case A, 260 na ilahang estimated. Sa case B is 225 sa market price per share. So sa case C, X Corporation issues 3,000 shares of the capital stock in acquiring Y Corporation. Sa ilahang capital stock, nag-issue sila og 3,000 na lang. Lahi sa case B o case A o case B, which is kanang equal ra siya sa katong kuan nang gingon nga 1-for-1 basis. Kani nag-acquire siya 3,000 shares. So annual earning after the merger have been estimated at 120,000 pesos. Market price per share shall be 250 pesos on the average. So after the combination, the figures would be as follow. As you can see in the illustration, we have here the net income per annum. Sa case A is 90,000. Mora ni ganiha kato na sa example sa babaw. I know. Kaning case A kuan ni naman 90,000 kay giusa naman ang Y, X ug Y. Sa case B mao ni nagkuan sila 120,000 and the case C 120,000 also. So the number of shares outstanding, no, 5,000 plus 5,000 is equals to 10,000 sa case A. And also sa case B, manigan nga 1-for-1 out, like yes, basis 5,000 plus 5,000, 10,000 sa case B. While sa case C, matong ingon nga 3,000 na lang the issues na matong 5,000 plus 3,000 shares na lang manang 8,000. So sa market price share man ilang given 216 sa case A, 225 sa case B, and 250 sa case C. So the computation for earnings per share and the PE ratio would be as follows. So inikuha nato sa earnings per share ng EP and the PE, price earnings ratio. So kaning sa case A, net income per annum divided by the number of shares outstanding. So 90,000 divided by 10,000 equals 9. 9 na lang ang earnings per share sa case A. Sa case B, 120,000 divided by 10,000, which is equals to 12 na lang agilahang earnings per share sa case B. While sa case C, 120,000 divided by 8,000 mao na nga 15 pesos sa case C of their earnings per share. So naman tayo earnings per share, makakuha na ta sa price earning ratio. So naman tayo given nga market price per share at i-divide sa atong earnings per ratio. So sa case A na sila 216, so i-divide na to sa 9 mo ng 24x. Sa case B, 225 divided by 12 mo ng 19x, and sa case C, 250 divided by 15 mo ng 17x. So in case A, the stockholders of Corporation Y shall benefit from the merger in terms of both earnings per share. So from 8 pesos to 9 pesos sa case A. And market price per share from 180 to 216. So 180 ra ilahang market price per share sa Y Corporation. And then sa motong sa case A, 216 na. For the stockholders for X Corporation, earnings per share and market price shall go down by 1 pesos. So from 10 pesos to 9 pesos na lang sa X Corporation. And ni down po og 4 pesos sa kaning market price per share. From 220 ilahang market price per share sa X Corporation, nahimo na lang 216. In case B, both the stockholders of X Corporation and Y Corporation shall benefit in terms of higher earnings per share and market price per share. While in case C, the issuance of a smaller number of shares shall raise EP ratio and market price per share to 15 pesos and 250 pesos respectively. Under normal condition, the given market price may still be considered attractive at the price-earnings ratio of 17x so that it may be expected to go up further. Manata sa earnings per share ratio and the price-earning ratio. Ari nata sa fair value of a company, number of shares to be issued. So, the amount to be paid for a company to be acquired depends on the results of negotiations between the different parties. They should agree on the fair market value of the net assets, including the goodwill. The following equations is applied. So, this is the equation. Estimated value of a company is equals to fair value of net assets excluding pa na ang goodwill plus goodwill. So, the fair value of net assets is arrived at by assigning the agreed values in the different balance sheet items as follows. So, as you can see in the balance sheet, so in cash, at face value, notes receivable at present value, the land at current market value, the building, machinery, equipment, and other depreciable assets are at current market value, while liabilities are at present value. So, goodwill may be recognized and its assigned value is generally based on estimated future earnings. So, in estimating the value of a company to be acquired, one may start with the latest annual report because it shows, among others, the following. So, here are the following. So, first is the list of officers. Next is financial highlights for past few years, such as trend in revenue, net income, dividends and earnings per share, payout ratio, cash flows, working capital, and number of employees. Next is the results of operations for the last 2 years. Next is the cash flows for the last 2 years, also the cash flows. Next is the balance sheet items as of the last 2 balance sheet dates. Next is ongoing and future projects. And lastly is disclosure of accounting policy, legal cases pending in court, contingent liabilities, and additional information on balance sheet items as contained in the notes of the financial statements. Take note of the notes of the financial statements. So, balance sheet items, excluding ang cash, are generally presented therein at book values which are based on historical cost. This is because of the stewardship function of accounting. Although asset book values may not be considered important, they may serve as a starting point in estimating the current fair values of some of the assets. So, we have here an example. Example is A corporation is absorbing B corporation. The condensed balance sheet of the former shows. So, sa illustration, total assets is equals to 209,000 pesos and the total liabilities is 55,000 pesos. So, to get the stockholders' equity or net assets, let's find the difference of them. So, 209,000 pesos minus 55,000 pesos rather is equals to 154,000 pesos. In going over the different balance sheet items and the estimated future earnings, the parties to the combination made estimates as to their present fair values and have arrived at the following. So, the total asset excluding ang goodwill pa is 200. We have here 237,144. Example rin ha. And the goodwill is 40,000. So, the total assets is 277,144. I-plus ra sila ang total assets and katong excluding ang goodwill, then ang goodwill. So, total assets including na ang goodwill is 277,144 pesos. To get the fair value of net assets atong i-minus tong atong example nga total liabilities. So from total assets including the goodwill atong i-minus sa total liabilities sa ganiha. So 277,144 pesos minus 55,144 is equals to 222,000 pesos. That is the fair value of net assets. So the expected consideration from A corporation must be equal to the fair value of net assets of 222,000 pesos. So next, we have here the promissory notes. As stated above, both notes receivable and notes payable are included in the computations at their present value. For interest-bearing notes, the present value is equal to principal plus interest that has accrued thereon. For non-interest-bearing note, it is equal to the face value minus the implied interest from date of business combination to maturity date. So, for example, one of the constituent companies in a business combination has a note receivable in the form of a 60-day, which is 15% note dated November 18, and 19B for 150,000 pesos. The business combination takes effect on January 1, 19C. The present value of the note as of January 1, 19C is 152,687.50 pesos because interest of 2,687.50 or interest for 43 days from November 18 to December 31 has accrued already on the note. It is arrived at as follows. So 150,000 nga katong November from November times 15% and times 43 days nga kuan ni dya from November 18 to December over 360 1 year. 360 days, 1 year na. So, is equals to 2,687.50, which is ang interest. So, if the note is not interest bearing and current interest rate is 18%, the present value of the note must be equal to 148,725, arrived at as follows. So here, face value of the note is 150,000 less interest for 17 days, January 1 to 18. So 150,000 times 18% times katong 17 days over 360 days nga equals. So 1,275 ang interest. So atong i-minus sa 150, 148,725 na lang. So the face value of a not interest bearing note is considered its maturity value or its value on January 18. The interest that corresponds to the remaining period of 17 days is deducted from this value to arrive at the present value of the note. So next is the depreciable assets. When assets of the absorbed company include those subject to depreciation, such as buildings, machinery, equipment, furniture, and fixtures. So those are the mag-depreciate siya. Their sound value is determined by an appraiser who considers their current replacement cost and present depreciated condition. Thus, if an item of machinery can be replaced by a new one costing 35,000 and the said machine is estimated to have depreciated by 70%, its sound value be 10,500 or katong 35,000 times 1 to 70%. So 70% of 35,000 is 10,500. So next is number of shares to be issued. If the consideration is in the form of shares of stock of a corporation, the parties have to agree on the number of shares to be issued considering the market price per share and the effects on the earnings price ratio after the combination. If the market price per share of stock of a corporation in the given example were 250 pesos, but both parties agree on a equation of 222 pesos per share, the number of shares to be issued by A corporation must be. So here is the equation. The number of shares to be issued by A corporation is equals to fair value of net assets of B corporation over the market value per share of A corporation. So 222,000 pesos divided by the 222 pesos is equals to 1,000 shares. The 1,000 shares to be issued by A corporation comes from its unissued capital stock. If it has 9,000 shares outstanding before the combination, the number thereof must increase to 10,000 after the combination. That's all. Thank you.
Okay, so distribution of consideration. Okay, in return for the net assets of the absorbed corporation, an absorbing company may give shares of its capital stock, cash, and other assets. Whatever is the consideration given, the transfer thereof is made to the absorbed corporation. The latter subsequently distributes the consideration received, which is the shares of capital stock, cash, or other assets, among its own stockholders in proportion to the shareholders of each of them. Upon such distribution, the stockholders surrender their shareholdings for cancellation. Example, R Corp and B Corp are parties to a merger with B Corp as the absorbing company. R Corp may issue shares of its capital stock or give cash or other assets to B Corp in exchange for the net assets of the latter, B Corp. In turn, distributes the consideration received, shares of capital stock of R Corporation, cash or other assets, among of its shareholders. Each shareholder of B Corp surrender his shareholdings in B Corp upon receipt of his proportionate share in the consideration given by R Corp. B Corp subsequently cancels its shares of capital stock in the process of its dissolution. Thus, if the consideration were in the form of shares of stock of R Corp, a stockholder of B Corp to one and instead becomes a stockholder of R Corp. Distribution of consideration received from an acquiring company. Whatever consideration is received from an acquiring company is distributed by an absorbed company among its own shareholders in proportion to their shareholdings. So the distribution ratio is computed as follows. Distribution ratio equals consideration received divided by number of shares outstanding absorbed company. So example of it is YCO with 1,000 shares of capital stock outstanding is being absorbed by XCO. The fair value of the net assets of the former, including goodwill, is 222,000 pesos. Next. Okay. Case A, XCO pays 222,000 pesos in cash. Case B, XCO issues 1,480 shares of its capital stock. Case C, XCO issues 111 uninvested stock of another company, MCO, which it previously acquired as investment. Case A. So, case A, the distributed ratio is 2.2, arrived at as follows. Distributed ratio equals 222,000 pesos divided by 100 shares equals 2.2 per share. Each stockholder of YCO receives 2.22 for every share he owns, so that if he has 200 shares of stock of Y, he is entitled to pay 444 pesos or 200 shares times 2.22 pesos upon distribution of the cash consideration. Case B, the distribution ratio is 1.48, arrive at as follows. Distribution ratio equals 148 shares of stocks of XCO divided by 1000 shares of stocks of YCO equals 1.48 or 1.481. Okay. Based on the ratio of 1.481, a stockholder of YCO having 300 shares is entitled to 444 shares of XCO 444 shares of XCO or 300 shares times 1.48. KC, the consideration is in the form of 1,110 shares of stock of a third corporation, MCO. The distribution ratio would be as follows. 1,110 shares of stocks of MCO divided by 1,000 shares of YCO equals 1.111. This implies that a shareholder of YCO having 100 shares is entitled to 111 shares of stock of MCO instead of becoming a stockholder of the absorbing entity. He becomes a stockholder of the third party. Okay, that's all for my part. Thank you.
Acquisition of controlling interest. Acquiring controlling interest means owning more than 50% of a company's voting stock, allowing the investor to control over half of board seats and decision votes. This establishes a parent subsidiary forming one economic entity due to the control exerted by the parent. Ito siya ang acquisition of controlling interest. Next is wholly and partly owned subsidiaries. Wholly owned subsidiaries occur when a parent company owns 100% of a subsidiary vote stock, while partly owned subsidiary involve the parent owning less than 100%. Minority interest represents the remaining stake held by others in a partly owned subsidiary, subtracted from the parent's percentage. Next, separate and consolidated financial statement. It is legally apparent and its subsidiary are distinct entities, leading to separate financial statements. So, makita